Hello, and welcome to the January 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, doing a solo video for you today. Today will be a short one. First, I'm going to go over the model portfolio performance. Then I'm going to show how returns in your portfolio and from your investments really only come from about 10 days over the year, which is why it's so important to remain invested and not try to time the market. So let's get started. The year-to-date numbers you see on the screen, as you can see for the month of January, so far most of you are relatively flat since you are either in the very conservative or the conservative model portfolio. Our growthier model portfolios with more stocks are doing better. That's because bonds over the past month or so, they've lost some ground, and that's because the Federal Reserve in the US and our central bank have both said that our economies continue to defy gravity and be strong. We've got low unemployment and strong consumer spending numbers. Now, that all translates to strong earnings numbers for companies, which is good for stocks. But unfortunately, that did push yields for bonds up and caused bond prices to lose a bit of ground. Nonetheless, this is supposed to be the year where interest rates come down. And right now in Canada and in the US, we're forecast for about 6 rate cuts. That will certainly be a huge boon for anyone that holds bonds, which means our conservative and very conservative model portfolio holders. And if this unfolds, I think as the market predicts, we could see a double-digit return, at least on the bond sleeve of those portfolios for the calendar year. So strong performance ahead, I think. So now I wanted to highlight something interesting I found. The piece I'm showing on the screen highlights the value of staying invested. Basically, for any investor, you significantly kneecap your returns by trying to time the market and missing the 10 best days. Timing the market means you'd be moving from stocks and bonds to cash or GICs. But what I found to be most interesting was the fact that the best performing days over the past 20 years were had during bear markets when things were going down. So if you look at the bottom of this slide I have up, the dates that correspond with these amazing market returns, like double-digit market returns over the course of one day, happened during the financial crisis and during the COVID crisis that we saw, financial crisis being 2008, 2009, and COVID being in 2020. The way I interpret that is that market returns, they're unpredictable. But the worst thing you can do when markets are going down or are already down is to sell, because at some point, like in every correction, we're going to have these insane market rallies and return days where investors regain much of what they'd lost. And that brings me to historically how markets behave every year. So throughout most of the calendar year, markets trade sideways. That means they're range bound. They might go up a few percentage points or down a few percentage points, but they kind of stay stuck. The real money investors make is generally made over those 10 days. Last year was no exception. So I put this together to show the S&P 500 returns, and the S&P 500 is basically the 500 largest companies in the US. Last year, large US companies measured by the S&P 500 index returned about 24%. The best 10 days in the market for the S&P 500, those days accounted for 19.3%. So almost 20% of the return, which is almost the full 24% return. And so every year as investors, for the stocks that we hold as investments, we hold it for exactly, those 10 best days. But the problem is we don't know when those 10 days are going to happen, which is why it's so detrimental if we decide to try to time the market, because we might miss out on those 10 days. And so, thank you for everyone that remained invested over the calendar year. Last year in 2023, if you reviewed your third quarter statement, it was ugly. It actually probably showed around a flat return or that you were barely up anything. But now you should have your fourth quarter end of year statement, which shows that the year ended quite strong and that your calendar year performance, regardless of the model you're in, if you were very conservative all the way to growth, the performance was quite good. And so now that we're in the new year, if you haven't already made your TFSA contribution, you might have received a reminder by us by email about 2 weeks ago, but just as a reminder again, your contribution limit has increased by $7,000. And almost everyone, if you've got the cash available or you've got non-registered money available, you should be taking advantage of this room and contributing $7,000 to your TFSA. And two, RSP contribution deadline is February 29th. So we've got about a month to make an RSP contribution, and that contribution can be used to reduce your 2023 tax bill. And that's it. Thank you so much for tuning in and listening to our monthly update for January of 2024. Hope you have a great month of February, and we look forward to sending you our next video. Thank you so much.